In fall of 2008, Wall Street's grizzly was awakened. She was hungry and she was mean. Banks were failing due to the collapse of the credit markets. The U.S. and world economies were on the brink of disaster. On Monday, October 6th, the bear started devouring Wall Street.
To the computer piece?
By the end of the week, the Dow Jones Industrial Average would fall 1,874 points, 18%. By January 2009, financial stocks in the S&P 500 index declined by 35% from May 2007. This erased more than $1 trillion in market capitalization and wreaked havoc on individual retirement accounts, 401ks, and pension funds. Rex Moore of Motley Fool says that in order to take advantage of the greatest long-term wealth-building machine available to us individual investors, we have to be in the market. And if the current craziness is keeping us away because we are fearing a huge drop, we're ignoring the advice of some of history's top investors. These time-tested strategies of diversification, long-term investing, dollar-cost averaging, and global investing maximize return while minimizing risk and enable us individual investors to build wealth in the markets and weather market tornadoes. In order to fully examine diversification, we need to review some prerequisite information. Securities are investment vehicles that are bought and sold to make money. They include stocks, bonds, mutual funds. With a stock, an individual has a claim to any dividend that a corporation pays and to any stock price appreciation. A bond is a loan to an entity, such as a city or a corporation. With a bond, the entity promises to pay a fixed amount of interest over time. At maturity, the entity repays the principal. A mutual fund pools money from many investors and invests it on behalf of the group in stocks, bonds, or other assets. Money Magazine senior editor Walter Updegrave says since most funds allow you to begin investing with as little as a couple $1,000s, or in the event of an individual retirement account with a couple hundred, you can attain a diversified portfolio and professional management for much less than you could buying individual stocks and bonds. An index fund is designed to mimic the returns of prominent benchmarks, such as the Dow Jones Industrial Average and S&P 500. The principal difference in benefit of an index fund and its benefit to an investor is that its management fees are a fraction of those of an actively managed fund. A portfolio is a selection of investment securities. Modern portfolios theory states that a careful selection of investment securities collectively will have a lower risk than any of the individual securities. This is due to the nature of markets. According to Charlie Farrell of North Star Investment Advisors, balanced investing is having some money in diversified stocks and some in high-quality bonds. It's a simple and very effective way to manage money over the long run. When you have a balanced portfolio, you don't have to predict the future in order to profit. If the stock market goes up, the value of your stock goes up. You still collect your dividends from stock, and you still collect your interest from your bonds. If the stock market goes down, it's a partial win. The value of your high-quality bonds has gone up. To preserve the value of your portfolio, you still collect interest on your bonds, and you collect dividends on your stock. Diversification, therefore, is investing in different securities in order to maximize returns and minimize risk. With a diversified portfolio, over time, an investor can realize the return of a single investment without the volatility of a single investment. Long-term investing means to select good companies or funds, buy shares, and hold. According to Morgan Housel of Motley Fool, the wealth of most billionaires is married to the stock market. Bill Gates of Microsoft, Warren Buffett of Berkshire Hathaway, Carlos Slim Helú with Teléfonos de Mexico, Sergey Brin with Google. All billionaires, all connected to stocks in the market. The late John Templeton, founder of Templeton Growth Fund, and widely regarded as one of the best investors of his generation, had some simple advice about getting into the market. The best time to invest is when you have money. This is because history suggests it's not timing which matters, it's time. How do we start investing? Brings us to the third time-tested investment strategy, dollar cost averaging. Dollar cost averaging is making fixed investment amounts at fixed intervals, usually monthly, in a specific stock, fund, or index fund. The point is to remain committed to this investment for years and not to allow fluctuations in price to affect your buying strategy. When the share price is low, because you're making the same contribution every month, you'll buy more shares when the share price is low. Then when the share price goes up, because you have more shares, you're making more money. A great approach for everybody, especially people new to investing and people with limited financial resources. The first three investment strategies, diversification, long-term investing, and dollar cost averaging, will be used for your U.S. stock and bond funds, as well as global and international equity and income funds. Why invest internationally? Well, if the U.S. happens to be suffering from an economic downturn or high inflation, there are probably going to be better investments abroad. And those investments could help boost a portfolio that has a lot of U.S. equities when the stock market here is not performing well. The easiest way to buy foreign stocks is through a global or international mutual fund where you get professional management that has expertise in the risks. Earning interest and taking advantage of compounding by long-term investing with a diversified portfolio may not produce the immediate jackpot that comes with winning the lottery, but the risk of ending up with nothing is far worse than waiting for a safe investment to pay off. If you get in the market, hold for the long term, consistently use dollar cost averaging, and invest globally, you will build wealth.